we're now on the other side of this hump in this slump in this recession, going into a more affordable rate environment, which of course, as a buyer of multifamily, if you're going to go out there and get a loan and purchase this stuff and try to cash flow it, you can justify raising your price a little bit with lower rates, because that's one of your biggest expenses on a property is your debt. So with that, the Fed watch, is pricing in a 92% chance, and some metrics and sources even higher, for an October rate cut, and then also pretty high probability for December. So we may see 2 more cuts.
Hey, good morning, everybody, and welcome. I know we are bright and early on the West Coast this morning at 9 a.m., and we are 3 hours later on the East Coast at 12 p.m. So grateful for you to be here this morning and join in on the presentation of the next chapter in multifamily. I'm joined today by our presenter, Travis Watts. He's the Director of Investor Development at Ashcroft Capital and a full-time LP. I've gotten to know Travis over the last couple of years very well, and boy, his insights and his knowledge of the market and where things are headed have been very fruitful. So looking forward. Travis, welcome this morning. How are you today?
Hey, doing great. Thanks so much, Mike. Thanks everyone for being here.
Yeah, and I just want to say a thank you to you also, Travis. Last week was my annual multifamily summit, and we had a great turnout. We had a great set of speakers, and I've had a couple of comments from people that you talk at a high level, and I said that's good, because that high level really causes people's minds to stretch a little bit, and I think that's where the learning happens. And we eliminate some confusion, and we eliminate some disbelief in where the markets are at and where things are headed by stretching a little bit. So I'm hoping you're going to do a little bit of that today.
Absolutely. Yeah, it'll be a different presentation, but there'll be some of the same elements in it. So ultimately, we're just going to talk about, where we've been the last few years with multifamily, where we're at today, and what's on the horizon looking forward.
Awesome. I'm just going to turn the reins over to you, let you run for the next few minutes, and then we'll come back and take some Q&A from the attendees.
Sounds good, Mike. Thank you.
You bet.
And again, warm welcome. Thanks everyone for joining us. I know it's bright and early. It's a work day, but there will be a recording as well if that's more convenient for you. So I'm Travis Watts, full-time limited partner investor, also the Director of Investor Development at Ashcroft Capital with Joe Fairless over there. So there's a lot to unpack here. And to Mike's comment, or one of the listeners, last week, one of their comments about kind of the macro level lens, I've always felt that's the most critical to understand. I could get up here and we could talk about intricate underwriting, and why a cap rate is this versus that, and what we think about the exit in 5 years and all these basis point spreads. But, I'm going to lose about 99% of you. So I like to look at investing, and I always have, from just what is the trend? Why is that the trend? How long might this trend continue? And then asking myself the simple question, should I be investing in this trend? So we're going to talk about trends in relation to multifamily apartment syndications, not financial advice, not legal advice, not tax advice. Please seek licensed financial advice as it pertains to your situation. Today is for informational and educational purposes only. So a couple of things I want to outline before we dive in is the macro of the macro, what we're going to be covering. So rent recovery and motion, what we're seeing in multifamily rents and single family. Are we in a holding pattern, or is this a pivotal moment in terms of interest rates? And then from boom to balance, what's happened the last few years, again, where we're at today, what the horizon looks like looking forward, and then tightening the gap, occupancy, absorption, vacancy trends, and then what are these economic trends that are shifting? What should we be paying attention to as investors? And then I'll leave you with some very practical key takeaways and insights, because I know it's very data driven here on this presentation. I want to make sure you have a firm grip and understanding of what we're basically trying to say in this presentation. So first thing I want to talk about is a market cycle. Doesn't matter if we're talking about stocks, crypto, real estate, multifamily, single family, there are market cycles, okay? Largely driven by psychology, which we'll look at here in a minute. But what we just witnessed since 2022 up to Q4 here in 2025 is we started going through the contraction phase. At first, that came in 2022 when the Fed stepped in to aggressively raise interest rates. So we saw increased new construction. Things were still in progress from the boom of 21 and continued on for the next several years. We started to see a flatlining and in some markets a declining of rents while this new supply started to hit the market and become new competition. And then we moved over here into the commercial real estate recession. Obviously, different asset types are going to perform differently in every market cycle. In this past cycle, office has been one of the hardest hit. We've seen some price declines up to 40-50% in some markets. It's been very, very brutal for office. Lots going on in that sector. But we're here to talk about multifamily, which still saw, again, some declining or stagnant rents, but it's held up fundamentally very well. We've seen some downward pressure, price corrections of 25 to 30% in some cases, other markets a little bit less than that. And so what we're really here to learn about and think about and talk about in discussion is this recovery phase. This is the next part of the market cycle that we're about to go into. And this is defined by very little new construction that is happening from today and looking forward over the next 5 years or so, potentially increasing rents at a more robust level than what we've seen the last few years, and declining vacancy, which is a positive, which means more people are needing and wanting rentals. And then, of course, we go into the expansion, which is everybody's favorite part of the market cycle when things really get rocking and rolling. You want to have your seeds planted by the time we get to expansion. Most investors, from a psychological standpoint, start to jump in the expansion phase. In my opinion, you want to be jumping in all the way through recession and recovery and then exiting towards the top of the expansion cycle. So here's another way to view what we just talked about. This is just kind of my opinion and interpretation based on the data and trends that we've seen, but this is basically what unfolded the last 5 years or so. We hit this euphoric peak in the cycle about 2021 as the economy starts to open up and rebound. And then the Fed coming in to say, look, we got to raise rates. We got to slow this down. Inflation's happening. We can't let this run away. So everyone got a little anxiety about how much they're going to raise rates and how quickly. And of course, they went at one of the most aggressive paces in U.S. history. And that kind of led us into a denial phase. Like, this isn't really happening. The Fed's not really going to go that high. They can't really sustain this. And then we got into kind of the panic, and that was what I would refer to as the capitulation phase, where a lot of operators were kind of throwing in the towel. A lot of investors were throwing in the towel. Prices came down. Cap rates went up. It got really ugly. Still is ugly. Not going to beat around that bush. But again, we're about to be out of the woods. Historically speaking, if we go back to 2008, 9, 10 with the real estate correction then, or even back to .com and other real estate cycles, it's not very common that we stay in a bear market or a down market for more than about 2 to 4 years, which we're coming up on that point here very shortly. So indications and trends that we may be getting out of the cycle sooner than later into the recovery phase. So let's take a look at 2025 Q4 right now. What's going on? So rents, this is from Yardi Matrix in the multifamily space, as you can see from September of 23 up to September of 25. So this is 2 years worth of data, have really kind of gone nowhere, right? They went down a little, they went up a little. They went down a little, they went up a little. But you can see we're hanging out between the 17 to 1750 range according to Yardi Matrix. And the forecast for rent growth is very conservative, 1.5 points. And for some perspective on that, we can take a look from the Zillow rent index. Multifamily is the blue line that you see here. You can see that on average from 2016 onward to the economy reopening in the midst of the onset of the pandemic, rents were going up about 4% a year. It's not an exact science, history doesn't repeat, it rhymes, but you get the point. It's basically it keeps up or is in slight excess of the government stated inflation in most cases historically. So we were chugging along, economy was fine, rents were doing what they were supposed to do. Everyone's making lots of money in these syndications. And all of a sudden, the onset of the pandemic, everybody gets uncertain, rents start going down, people are doubling up on rentals and moving back home and losing jobs. And so things got scary for about a year. And that's when rents dipped pretty aggressively. And then we saw a resurgence and a skyrocketing of the economy rebounding and opening. And we saw these double-digit rent growth numbers, which, nobody was really forecasting that as far as underwriting. People were going with kind of the 3 or 4% a year. And all of a sudden in some markets, you're seeing, 15% rent growth. So this is what prompted developers to start saying, hey, wake up. We got to jump in on this market. These prices are going up and rent's going up and everyone wants these apartments. Let's get in. And so building just takes off like a rocket in 21. And it takes several years to build, multifamily complexes. So the story then kind of shifted in 23 and 24 and still here in 25, that all of that product has been hitting the market. All these vacant apartment complexes are coming to market and they're open for business now. And so the common strategy that gets played in those instances is let's reduce rents or let's give concessions and incentives to get people to rent from us this nice, new, beautiful Class A building instead of them going to this 1980s vintage, older property over here that's already stabilized. So it gets very competitive because all of a sudden these brand new Class A luxury rents are artificially low or incentivized. And so it's hard to choose the older properties with the older amenities and the older pools and all this stuff when you can live in a brand new facility. So that was kind of the trend that unfolded there. But the reason I want to show this graph in particular is that the way I interpret this data right here that we're looking at is it's basically that we just did a return to normalcy. That's basically what happened. We had normalcy, then we had a dip, then we had a boom, then we had a bust, and now we're just basically back on track for rent growth stabilizing and gradually continuing to increase year over year. Now, something to think about on top of all of those trends is, when you're an American and you're thinking, do I rent? Do I own? Something really unforeseen happened during this crazy commercial real estate recession this time. And it's that single family homes in most markets continued going up. So here you have commercial falling 25, 30, 35, even 40% in prices. Again, using the office example, you have single family not going down much, if any, and mortgages doubling. So it became way more expensive, the most expensive ever in US history for somebody to own and purchase a single family home. So when you run the math and the numbers, I know there's a lot of psychology to this as to why, people want to be homeowners and why you would want that over being a renter. However, renting is the logical choice for the last several years and has been, for quite some time now. So about $1,000 a month or more differential or spread between your average rent and your average mortgage cost. So it's cost prohibited for millions of people, which is why we're seeing this huge resurgence in interest in renting. By the way, first time US home buyer age, never been higher in US history. It's now 38 years old. Pretty crazy to think about. So some more trends that are important. Of course, let's talk about rates. That's the elephant in the room. So rates have been coming down. The Fed finally cut in late 24. They cut again here in September of 25. The anticipation is that they're going to cut next week on October 29th. That's already priced into the market. That's never a guarantee, but that's what investors expect at this point. So we're now on the other side of this hump, in this slump, in this recession, going into a more affordable rate environment, which of course, as a buyer of multifamily, if you're going to go out there and get a loan and purchase this stuff and try to cash flow it, you can justify raising your price a little bit with lower rates, because that's one of your biggest expenses on a property is your debt. So with that, the Fed watch, is pricing in a 92% chance, and some metrics and sources even higher, for an October rate cut, and then also pretty high probability for December. So we may see 2 more cuts. No one knows if these are 25 basis points, 50 basis points, but basically the majority are voting on a 50 basis point cut reduction by the end of the year. So that would bring the 10-year effectively down to, somewhere around 3.5%, give or take. So in regard to this, we've seen a couple trends unfold because of this new, forecasted rate declining environment. One, we've seen that a lot of people got a little bit too cozy up with their money market funds, getting their 4 or 5%, taking very little risk as commercial went through, a downward spiral. So we've seen a resurgence in these note funds and these debt funds, or, to get any kind of double-digit cash flow, say 10% yield off of some kind of pref equity funds and stuff like that. Because in a declining rate environment, if you're sitting there in your money market account or your high yield savings at the bank, and they keep cutting and cutting and cutting, you're getting less and less and less of a return and a yield. And at some point, investors commonly will look at that and say, well, I'm only getting 2% now. Inflation's running at 3, I'm making 2. I'm actually losing money. So I better go move my money into something else where I can make a higher potential return. The other thing that we've seen that I briefly already mentioned with the new development is, over the years, it's gotten really expensive to build. The cost of materials and wages and just permits and the bureaucratic side of things. And so all that's really been coming to market are these luxury Class A apartments that rent for roughly $2,000 or more per month. So we've seen a flight to quality, as we like to say, where you may have been buying C-class or B-class apartments in the past, and now you're saying, why not own a Class A property? Nicer, newer, safer. Maybe I don't even have to turn the units on it. Just kind of, buy into it, cash flow it, and wait for this economy to kind of turn around, interest rates to come down. Maybe you can do a refinance or a sale here in the next few years. So kind of a different lens to look through, so to speak. So let's talk about the construction landscape real quick. Very, very important. This is one of the most important charts I wanted to show you today in this presentation. And this is basically where we are today as far as deliveries and where we're anticipated to be moving into 26 and beyond. In my opinion, this is one of the strongest data metrics to look at when you think about, should I invest today if I'm going to get into an illiquid deal for the next 2, 3, 4, 5, even 6 years. This right here just tells the story, right? So a lot of starts happened, as we discussed, throughout the pandemic into 21 and early 22. That was kind of peak pricing era. And then they've been scaling down. Builders have been building less and less and less because things got really expensive. Pricing came down, underwriting and the math just stopped making sense. And so more and more started to pull out and continue to pull out. And the peak deliveries hit between 24 and early 25. But as you can see, they're projected to hit a massive free fall downward. And at the end of the day, I'm sure you know this, but real estate is supply and demand driven. So you got 150 renters out here and you got 100 units available. You can justify lifting the rents a bit in that instance. And that's exactly what we're about to see. I'll show you that chart here in a couple minutes. So approximately 300,000 units were absorbed the first half of 25, putting the market on pace with 2021's strong post-pandemic recovery. Meanwhile, occupancy has stayed in about the 94 to 95% range, which is considered, high occupancy or stabilized occupancy, I guess I should say. And then vacancy Obviously, that's kind of the inverse of what we just talked about. So about 5% vacant on your units. So this is the next important chart here from Marcus and Millichap, helping explain what I was just saying verbally. You can see here in the orange, this is your net absorption. That's how many renters are getting absorbed into this new product or all product that exists out there for renters, vacant units, Meanwhile, completions have peaked and are tapering off in a downward manner. So what that's telling you is there's basically already more renters than there are units available. And that may not feel that way. And you may not think that because of a headline that you read about, oh my gosh, all this new supply, we're flooding the market with all these new units. But it takes time for these to fill up and for all of this data to really be seen in real time. But there is, just millions and millions and millions of renters all the time coming into the market, younger kids graduating, going off, renting. And so, yes, there is an overabundance of new supply and has been the last 18 months or so, but it is tapering off. And so you can see here also on this chart, if you look back at 07, 08, 9, and 10, you can see what happened there was a totally different story. You really had a massive drop in absorption as people not renting apartments, so kind of the opposite trend. So we're going in a much better direction, much healthier path than the recovery from 08 and 09. Now, talking about household growth forecast, you can see these are some major markets here in the US stated on the bottom. On the left, in orange are a lot of the markets that we operate in. Not all of them, but some are target markets. But you can see what's starting to rebound. We got a big presence in Orlando. That's ranked up there at number 2. We have a very big presence in Dallas, Fort Worth as well. That's in the top 5. West Palm Beach area, we're just south of there. So I won't read all of these markets to you, but basically the Sun Belt is forecasting still continued growth and future growth. So the Sun Belt already was booming and then kind of had its bust for a couple years as we went through the cycle, and now is continuing its strong rebound. You can see that here with job growth. This is as of August of 25. Different markets listed below, but you can see some common themes among Orlando and Tampa, San Antonio, Dallas, Fort Worth is number 3, Raleigh, Durham, Atlanta, etc. So basically, transaction activity is robust and it's picking up about 35% year over year, prompted by a very strong Q2 and also prompted by another economic trend, which we'll look at here in a minute, which is institutional capital entering the space. These are your BlackRocks and Blackstones and Goldmans and KKRs and JP Morgan Chases and basically Wall Street, simply put. So Q1 absorption in markets like Atlanta, which was one of the hardest hit absorption markets for a couple of years, is seeing one of the strongest rebounds at this point. Dallas-Fort Worth continues to grow, to build, to diversify. Companies continue to relocate their headquarters there. People continue to move there for the jobs. These just a couple notable examples that are somewhat recent here. Blackstone making a $10 billion multifamily purchase, going on the offensive. They also called what they say is the bottom of the market in 24. And KKR purchasing billions of dollars as well. There's so many other notable examples, but I just wanted to share some of these from very reputable sources of what's going on. Mike and I talked about this on the summit a little bit, but this is what some people refer to as the smart money, the institutional capital. It's moving. It has been moving. Most or many have called for the bottom, now see upside ahead from here. So the takeaway here is that you and I have an opportunity to participate in this stuff. Maybe not at a $10 billion level, but just because Blackstone's buying at $10 billion doesn't mean you can't invest 100,000 into one individual syndication deal with some operator that like, and trust. So in a short recap, and I'll spin this 2 different ways for some practical takeaways, these are kind of the top 5 that we look at Ashcroft Capital, that I look at as an LP investor. You have rising demand, you have rising absorption, you have lower new supply in a very drastic way, not just lower new supply, but like new supply falling off a cliff, and remembering it takes years to build. So even if developers jump back in right now, today, all at the same time, we're still going to be 2, 3, 4, 5 years out from seeing those new units come to market. Stabilized occupancy shows very strong fundamentals and demand. Forecasted rate declines makes it more affordable and helps boost valuations. Growing investor sentiment, both among retail, more in the short term on that, and institutional over about the last year or so. So adapting to the 2025 trends, remember multifamily's on sale. As an investor, I'm always looking out at kind of the macro sectors and asset classes, and I'm thinking, okay, crypto's almost at an all-time high and the stock market's almost at an all-time high, but commercial is still 25 to 30% off in many cases. And you're still able to buy some of these deals below replacement cost, which is what we're doing on an Orlando deal right now. And then following the flight to the quality, again, you might be able to make the case. I think it's pretty easy to make the case for why Class A today. Whereas if you asked me 5 years ago, I would have said, no, I don't do Class A. I just don't invest that way. But now it makes a lot of sense for different reasons than 5 years ago. Refinance opportunities on the near horizon, hopefully to help out some of those peak price purchases. And also, if you are getting in a deal today, as rates are still relatively high, you may be able to refinance sooner than later and improve cash flow or return some money to your investors, things like that. Don't wait for the headlines. I wish I threw a map in here or a chart that I saw the other day. And it was basically when the mass media called the bottom of 08, 9, and 10. It wasn't until like 2011 or something like that. In other words, they were way wrong. They were more than a year off from when the market actually bottomed and was already in a recovery phase. So you don't want to sit there and wait until things have already gone up, 20% from here. And then now you're kind of late to the boat, and then you might get struck by the next cycle there. So focus on cash flow over speculation. Now's a great time to have positive cash flow on a deal, again, that you may be able to refinance in the next few years to help improve those conditions. But if you cash flow at these rates and the Fed doesn't change them, you're still in a good boat. So I want to leave you with this one last chart here, something to think about. Commercial real estate total returns over time. This goes way back, I think, to 88. Dark blue line is commercial real estate. So these were kind of your bottoms and your dips. In the early 90s, this was the Great Recession. Obviously, we saw a big dip right there, but it was also a V recovery in a very big way. And then here's your opportunity looking at 25. Again, if you subscribe to the philosophy and idea that we've already bottomed, we're already in a recovery phase, many would argue. So this is your opportunity to more or less to buy the dip. So thank you guys. I appreciate that. I hope that was of value. Be happy to discuss any of this in more detail with you. There's a QR code here on the right of your screen, or you can simply go to speakwithtravis.com. And I give out my time in 15-minute intervals to anybody and everybody, accredited, non-accredited, Ashcroft, non-Ashcroft, new LPs, experienced LPs. So let's connect. I'd love to have a deeper conversation with that, Mike. If we have any questions, happy to dive into the Q&A.
Yeah, Travis, thank you. That was awesome. And I have a couple comments. Can you go back to that last slide?
Yeah, absolutely.
I love this graph. And, so many times people say, hey, this is, are we like where 2008 was, that the market is going to go sideways? And if you look at this graph, 2008 really was the worst, right? Yeah. And all the way back in 1990 was similar to where we're at here in 2025 when you look at that dark blue line. And, the comment I like and I say often is, hey, there's no geniuses in this business. There's only market cycles. And if you want to try and be a genius right now, take a look at this graph and, come off the sidelines, because smart money doesn't lie. And you kind of mentioned that, right? You got Blackstone jumping in the market. You've got, Warren Buffett, who just made a big investment in real estate, and, Jeff Bezos, who's talking about it. So, when we talk about smart money and we talk about the Blackstones of the world or American Homes of the world, so much of what we do is driven by the residential sector of the market. If you look at car sales is driven by residential. And, so the market cycles are, and where we're at right now, there's a lot of opportunity out there. And for people, and I love this, right? You made the comment, you and I've had this discussion about mainstream media. If you wait for mainstream media to say the market's changed, you've probably missed 2 years of the market increase,
Right.
and it's blown by you. So I do have a question. One of the attendees said, "Why, if there's not enough homes on the market, we have a housing shortage, are there still concessions happening in the multifamily space?"
That's a great question. And just for perspective, and again, I wish I had the graph for you here. I've looked at it several times. We've actually been in a housing shortage since about the year 2000. So we just have not been keeping up at the pace we need to for the inward migration that we have. And then every time you hit these downturns, which again, 2000, 2001 made a little bit worse. And then of course, 2008, 9 and 10, builders really scaled back. And so as things reopen, we're just kind of years behind at that point. And now we're seeing it in one of the biggest ways that we've seen in a long time. So, first of all, I guess just to note that from kind of the highest level that we've been in a shortage this long. But when you build something brand new, say you're building a 300 unit multifamily complex. In fact, we've been up against some competition out here in Orlando on one property that we have where there was 4 different neighboring properties all leasing up at the same time. So it's kind of like the old school gas station wars where you got 4 gas stations, one on each corner,
Yeah.
and they're all going 1 penny less. It's kind of like that. You want to be the one who fills up the fastest, stabilizes the quickest, and then you can make your transaction and your sale and get out. I mean, that's what most developers are looking to do. They either trade it hands vacant and the next group will fill it up, or they try to fill it up and then they try to trade it hands at that point. So we're seeing that because that's just how the business goes. If you go out there and you're a stickler with a brand new empty building and you're like, nope, $2,500 a month, we're not dropping 1 cent, well, you can do that, but it could take you 3, 4, 5 years to fill that building up. So it's just better in many instances to say, okay, $2,100 a month. Let's just, rock and roll here for 6 months and see what we can do. So just how the business works. I wish I had a better answer for you.
Yeah, I don't know that any of us have real good answers for how these things cycle, but they
Yeah.
happen, and it's just a matter of taking advantage of the opportunity. Travis, thanks for being here today. I appreciate you. I appreciate your insights and your knowledge. Listeners, feel free to reach out to Travis, pick his brain, jump on his calendar. If you're looking to participate in the multifamily investment space right now, now is the time to get involved. If I can answer any questions for you, you always know where to find me here. Like our content, love our content, subscribe to our YouTube channel, and we're here to continually bring you good guests, good opportunities, and good investing knowledge. Thanks, Travis. You have a great week ahead.
Thanks, Mike. Thanks, everybody. Take care.